for the companies, uh, that Schedule 3 is been revised, and the amended Schedule 3 is applicable from financial year 2021-22. એટલે 21-22 ના વર્ષનું જ્યારે આપણે અત્યારના કંપનીઝના ફાઇનાન્સિયલ કરીએ, and when we look at the review of the notes and account Schedule 3 Excel financial statements, we have to ensure and see that the amended Schedule 3 is applicable. See, દરેકની પાસે private limited company હશે, અને these changes are applicable to all companies. ફોર્મેટ જે છે એ એક્સેલ ફાઇનાન્શિયલ ફોર્મેટ, નોટ્સ ઓન એકાઉન્ટ્સ, ડિસ્ક્લોઝર્સ, એ બધા જ આપણે શેડ્યુલ 3 જે અમેન્ડ થાય છે એ પ્રમાણે આપણે કન્સિડર કરીને કરવું પડશે. કારોમાં અમેન્ડમેન્ટ છે, પણ અગેન એપ્લિકેબિલિટી ઓફ કારો ઇઝ નોટ ચેન્જ. જેને કારો એપ્લિકેબલ છે એ લોકોમાં કારોમાં there are more points are added where the auditor are required to comment. So before we talk about the changes per se, let me first talk about the recent news item and recent message from President of ICI, Debashish Mitra ji. And the headline was there in the newspaper where it was mentioned that audit is a serious business. Stay away from it if you can't meet expectation gap. Just look at the statement, bold statement. I will say bold. Why? Because being a president of ICI, asking the members to stay away if you can't do it, I think it's a very bold statement. And where it says that my message would be to look for alternative avenues, litigation, GST, insolvency, valuation. There are many avenues that are available. So, however, the objective is that he is trying to say that I am trying to give is the audit is a serious business. So, if you can't meet the expectation gap, not only will you get yourself into trouble, but will also get the institution down. See, નફરા અને એટલા બધી વસ્તુઓ અત્યારે ચેન્જ થઈ ગઈ છે. The way the earlier the audit have been done, the way the financial statement have been done, the way the regulators have been going to earlier and now, I think there's a vast change. Now, if you are unable to upscale ourselves with this requirement, and we sign something which is not in compliance with this requirement, I think then no one can save us. We are responsible because that's something which is already disclosed, already reported, already signed. And the Prime Minister of India, Modi, has made it very clear that તમે જ્યારે સાઇન કરો છો ને એ વખતે you have to ensure that everything is right, correct, and then you sign it. So your signature means you have considered everything. I understand that we have bottlenecks, like for so many cases we rely on our staff and articles. However, the government says it is your responsibility. Whether you get it reviewed by somebody else, not do, that is your responsibility. We can't say anything about that. So I think there's a lot of change as far as the expectation gap is concerned, and the audit is something very serious business. It's not something where we can do just for the purpose of sake of signing it. Let us look at a few very important points before I talk about the changes. And these points are very important from the way that I would like to explain you the basics of Schedule 3 and how they all have been construed, and then what is the main objective and why this is so much relevant. Let us look at first is the format of financial statements. So when we talk about Schedule 3, I think there is a lot of discussions on Schedule 3, and Schedule 3 is nothing but the providing a format of financial statements. Accounting standards does not provide the format. We just talk about Ind AS. Under Ind AS 1, there is a format that is provided which provides a format of balance sheet, profit loss statement. However, AS does not provide any format in which the accounts to be prepared. So for companies, the format is governed from the Companies Act 113, Schedule 3. Schedule 3 has 3 divisions. Division 1 that provides a format for accounting standards. Division 2 that provides format for Indian accounting standards, Ind AS. And Division 3 that provides format for NBFC. At the cost of repetition, I am again repeating that the amendments which I am talking about in this particular session, these amendments are effective for financial year 2021-22. તો અત્યારે આપણે જે બેઝિકલી કરીશું, the whatever changes which we, whatever finalization which we'll do for any company, for all these companies, even the small, micro, macro, for all these companies, this is critical that we need to comply with these requirements. The second is not applicable to section 129 subsection 1. Now section 129 subsection 1 says that it is not applicable to the banking, insurance and companies which is in the supply and generation of power or electricity. So banking, insurance, there is a separate act. For banking, there is RBI which provides the format of financial statements. For insurance, there is IRDA that provides financial format. For generation or supply of electricity business, the Electricity Act or rules does not provide a format. So for electricity company, you have to follow the format as per Schedule 3, Division 1 or India's as applicable. Now coming to the next part, there is a very important is about guidance note. Guidance note issued by ICI, is it compulsory for us to, because I must say that in case if you really want to get more information, detailed insights of this Schedule 3 amendments, the ICI has issued a guidance note, and that guidance note provides a very important analysis and understanding of the Schedule 3. So the question comes into picture that if there's something which is provided in the guidance note, and that may not be exactly which is written in the Schedule 3 MC notification, are you required to follow guidance note? Or can you say no, guidance note is only for guidance, I may or may not follow it? So first we need to understand the purpose and the objective and the authoritative literature guidance note. See, guidance note by word is providing guidance. However, this is applicable and compulsory for practicing CA. So if I am a CA in practice and I am signing financial statements, for me, compliance of guidance note is very important, and I have to abide by this guidance note. Why this is so such? Because guidance note is issued by ICI. It is not issued by any regulatory authority. So non-CA companies can say that they are not bound by the guidance note. However, a CA who is also required to bound by the Central Council directions and guidance which is provided by ICI. So in that case, this guidance note is compulsory for all of us, and we have to ensure that the guidance note has been complied with it here. Before I proceed further, if you have any question, please feel free to ask question at the same time. There is no need to really wait till end, because I always believe that study circles are a very critical, very important part, provided they are like study circle. And for study circle, the most important thing, there has to be interaction, there has to be discussion. And unless there is instruction discussion, we can't say there is a study circle. So if you have any questions, you may, I think if admin allows you, you may unmute and speak also, or you can put your questions in comment box, and let's have try to interaction discussion, because my objective is to not really cover 100% because it's an ocean, but my objective is to really cover very important points, and also to have a discussion interaction, so that we all are serious and sincere as far as the compliance of this is required. Now let us look at the amendment 24th March 2021. So 24th March 2021 is a date on which the MC has issued a notification for amendment of Schedule 3. Earlier it was applicable for year 2021, however then it was deferred to be applicable from 2022. Again, I am saying CARO 2020, which was again deferred, and now it's applicable from the year 21-22. So for financial year 2021-22, એમાં CARO અને Schedule 3 બંને નવા છે, બંનેમાં ચેન્જ છે. એટલે જ્યારે આપણે આગલું ફોર્મેટ યુઝ કરીએ ત્યારે જોવાનું કે શેડ્યુલ 3 નું ફોર્મેટમાં થોડું મોડિફિકેશન કરવું પડશે. There may be more additional disclosure which is required. CARO there is a substantial amendments by way of increase in the clauses. So these both things we need to really take into consideration when we finalize the audit. Now coming to the next part, that is a very important part, is a comparative. Schedule 3 ની અંદર division 1 માં division 2 માં just starting માં એવું કહે છે કે whatever figures that is provided under division under schedule, that all figures should have the comparative figure. So એક સ્ટેટમેન્ટ ઓર શું થાય છે કે મારા બેલેન્સ શીટ, પ્રોફિટ લોસ સ્ટેટમેન્ટ, ફેસ ઓફ બેઝ PSPL plus notes on account, they all are part of my financial statements. So financial statements માં જ્યારે જ્યારે હું ફિગર મોકલું એ દરેકે દરેક ફિગરમાં પ્રીવિયસ યર ફિગર હોવી કમ્પલસરી છે. તો એનો અર્થ શું થયો? એનો અર્થ એવો થયો કે that means what, the amendments which you are talking about, which is applicable for financial year 2020-22, the said amendment are also required to be applied for a previous year, that is 2021. So the changes which you are talking about, we need to really do changes for both years, current and previous year. Now come to the next part, that is interim reporting. For interim reporting, AS and INDS talks about that thing. There's AS 25 and INDS 34. They both provide the guidelines for use of format for interim reporting. See, for interim reporting, it says that if you are using condensed financial statements, if you are publishing condensed means it is not a full-fledged financial statement. There is no notes to account. There is nothing exactly as for full financials are provided. It's condensed. If you use condensed financial statements, your reporting format should be same as of your latest published financial statements. And if you prepare full financial statements, then it should confirm the requirement of the applicable format for March 22. So that is what is provided under interim reporting requirements. Now, before I move to the changes in Schedule 3, I would like to again focus on very important part, that is a comparison between AS and Schedule 3. Accounting standards and Schedule 3 when we compare. And why this comparison is critical? Because Schedule 3 provides certain disclosures. There's certain information which has been termed into the Schedule 3. And there are few definitions which is provided by Companies Act. So there can be conflict between AS and Schedule 3. In that case, Schedule 3 has made it very clear point that in case of conflict between AS and Schedule 3, AS will override Schedule 3. So as far as any information is concerned, AS, if there is a conflict or there is information is provided under AS and Schedule 3 both, then AS will override Schedule 3. We need to follow what has been provided under AS. I think we are aware that there are few definitions, terms which are being used and which have been explained by MCA in Companies Act 2013. They are defining what is associate, there's definition of control, the definition of related parties, and same definition are also explained under account standards and INDS. The definition is provided under Companies Act is not exactly the same as for AS or INDS. However, as far as you have to comply with the Schedule 3, we need to refer to the definition as per accounting standards and not as per the Companies Act 2013. Let us look at next point, that is on cash and cash equivalent. If you refer to AS3 provides the definition of cash equivalent. And as per AS3, cash equivalent is basically it talks about where it can be readily convertible into the cash or equivalent money and having the original maturity of less than 90 days. Under Schedule 3, the format of financial statements, they have mentioned cash and cash equivalent as a word. However, there are other bank balances which are not as per cash and cash equivalent, which should be shown as part of other bank balances. So, what can be done? You can have a CCE, that is cash and cash equivalents, and then you can also have other bank balances, and then total becomes a cash and bank balance. So you can comply with both AS3 and also a Schedule 3 by having a separate cash and cash equivalent, which is as per AS3, and then other bank balances, which is then you can have a combination together is a cash and bank balances. Coming to next part is a discontinuing operations. For discontinued operations, basically the Schedule 3 does talk about having a separate classification of continuing operation and discontinued operations. However, we have to have a discontinued operation separately. Why? Because AS24 and India's 105, they both provide guidance that in certain cases you have to show continuing operations separately and discontinued operations separately. So again, in this case, you have to follow AS India's requirements. Next part is on EBITDA. We look at the profit and loss statement, financial statements. EBITDA is not being shown separately. However, there are certain banks where they look for EBITDA because the company's main objective of preparing financials is for providing to banks. So the Schedule 3 says that in case if you wish, you can modify the format of financial statement that suits your investors or stakeholders requirements. Now, come on, next part, which is a very important point, is the change is a rounding off. Biggest very important change, rounding off. Because in majority of the small companies, what we have observed that we provide generally full figures. There's no rounding off is done. Full figures of sales, purchase, all items, P&L account, balance sheet is provided because management wants that should full plus. We got figures from Tally, and why we have to spend so much time on doing rounding off. So in majority cases, rounding off is not done. However, now rounding off is compulsory. So we need to also see that we have to do round off of all these things as per these requirements. Coming to next part, there is on investment, there is long term versus non current. When you look at AS13, under AS13, they use a word is a long term. There's no use of the word like non current. When you come to the Schedule 3, there's a classification of current non current. So for Schedule 3 is concerned, we need to have a basically classification as per current non current. However, as per AS13, it should be long term. But AS13 does not talk about presentation. For presentation, we are governed by Schedule 3, so we can use the same word non-current, which has been used under Schedule 3, and there's no need to change to long term. This is the just basics of Schedule 3. Any questions so far? Before I move to the next part, if you have questions, please feel free to write in chat box or unmute and tell me. Okay. I'm moving ahead, but in case no need to worry about, just write down your question and we will go ahead. Let us now have understanding of the amendments in Schedule 3. As I talked that Schedule 3 provides format Division 1 AS, Division 2 for Indias, and Division 3 for NBFC. All the changes which are done for Division 1, they are all also done in Division 2. All the changes which are done in AS are also done in NBFC. So at this juncture, I am talking about the first amendment which are applicable to both Division 1 and Division 2, or for Division 1, these amendments are applicable. So when I say Division 1, means it is to all AS companies. Everyone has a private company. So these changes are applicable to every private limited company for which we are going to sign. Now let us look at first part is on there are 6 amendments which I believe are with respect to improving and transparency and useful financial statements. What I have done, that this grouping I have done from my point of view, because I just wanted to understand that what is the reason or logic for making these changes. So I understand that there are six changes which are which I can say the objective was to improve transparency and useful in financial analysis. There are two amendments which are for closed group related. So just a bit, let me see that battery is charged. Fine. So there are six changes which I feel are primarily just to improve financial statement transparency, and they are useful in financial analysis. Then there are two changes where the focus is to provide information on closed groups. There are three amendments where their object is to provide control on property, and then there are five amendments which are primarily to ensure the fund movement is being controlled. Just to ensure compliance with laws and disclosure, there are five amendments, and there are five for which changes presentations. So just look at, there are 6 plus 2, 8 plus 3, 11 plus 5, 16, and 10, 26. There are 26 amendments, small, medium, large amendment, which are required and understood. For a small company, there may be a less changes. However, we need to aware about these changes. Let us first look at on six changes which are on improving transparency and useful financial analysis. There is a need to provide a trade receivable aging, trade payable aging, disclosure regarding revaluation, CB and intangible asset under development aging, and there are 11 ratios. So these all changes, when you look at, you will realize that everything has been given into financial statements. As we discuss further, you will realize how it's going to impact every company. First, trade receivable aging. In the time, the trade receivable aging શું હોય છે? Simple. 6 મહિનાથી વધારે અને 6 મહિનાથી ઓછું. બહુ જ simple માં 6 મહિનાથી ઓછું. Less than 6 months, more than 6 months. These we are providing since so many years. Now, if I just provide you some information saying that my less than 6 months is 4 crore and more than 6 months is 6 crore, my total is 10 crore. If that is being provided as per the old schedule 3, then what we will believe? Fine, this is fair. Why? Because more than 6 months je છે એ 6 crore possible છે. In today's situations, having more than 6 months is not a very big deal. There are many receivables which are outstanding for more than 6 months, where credit period has been extended beyond certain period of time. So this is okay, but however, now it says that you need to provide aging in 6 months to 1 year, also 1 to 2 years, 2 to 3 years, and more than 3 years. So more than 6 months is now classified to further 4 buckets. That is 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. As I mentioned that this is an aging. Aging means it will compute from the due date of payment. From due date of payment means what? That means that if you have sold goods to customer and the customer has given you a credit period of 30 days, it is receivable or outstanding will start from the day, from the end of the credit period. So we need to compute aging from the due date of payment, that is from the end of the credit period that has been given to the customers for making payment. From that date onwards, you need to compute aging. And 6 months to 1 year, 1 to 2, 2 to 3, and more than 3 years. Now let us look at this 6 crore, which I talk about, which is more than 6 months. It out of 6 crore, 2 crore is of more than 3 years. 1 crore is 4 to 3 years. For 1 to 2 years is a 2 crore, and for 6 months to 1 year, 1 crore. Now, if these are situations, this will definitely raise a lot of eyebrows. Why? Because more than 3 years is 2 crore. And that has been not treated as a disputed, that is not treated as doubtful. They all are said good. So, good receivables is of 2 crore, which is outstanding for more than 3 years. Then this is just raise a question in the mind of stakeholder that how it can be a good, or what is the reason why this amount has been outstanding for more than 3 years, even though you're saying it's a good, even though you're saying it's not disputed, you're not provided for. Now the question will again come, then what is the amount of provision you've done? Have you made provision of 2 crore? Whether the provision which is made in the books of account is sufficient provision, or the provision which is made is not sufficient. So this all will be basically providing a lot of information to first company management, where they may have to provide more if the amount is provided is not sufficient. Also, it raises questions on auditor, that how you finalize, why you're not given a qualified report, why the provision is so less, what kind of documentation you are having to ensure and confirm that the amount of provision which is done is correct. So I think this is what which we all need to do it, and this aging will be really providing much more information to all of us. So we have to be vigilant when the information is provided, because collecting information is one part, and analyzing information and ensuring that information is provided to and fair view is another part. This information was never being produced or presented in the financial statements. So no one was aware about this kind of the aging, where the amount has been outstanding for a long period of time. Now this information is going to be on the face in the notes of accounts. So in that case, it is critical for management and the auditor to justify the classification of these receivables over a period and the amount of provision which is done. That is the one very important change as far as everyone is concerned. Next part that is on, as we are aware that trade receivable shall be subclassified as a secured considered good, unsecured considered good, doubtful. So that classification will be definitely there. So it is like dividing the whole receivable into three parts: secured, unsecured, good, and doubtful. Now coming to question that no due date payments. See, I think in small companies generally we have seen that there is no mention of the credit period, or if something is mentioned, it is never seen that there's credit period is mentioned. Then what? So if the credit period is not mentioned, in that case, the transaction date or invoice date will be the date that will be counted as a part of your due date. So, for example, if my invoice date is the 1st January, the credit period is not mentioned. So, from 1st January, I have to look at outstanding aging. So 1st January to 31st March, it is outstanding for 3 months, which is in the bucket of 6 months to 0 to 6 months. Unbilled dues. As per this period schedule 3 is recovery is concerned, it says that if any unbilled dues is there, it has to be disclosed separately. Now, question which can come to mind: what do you mean by unbilled dues? Unbilled dues generally can come into picture only in case of a certain service industry, like construction contract services which is provided. The bills are not raised. However, there is a revenue is recognized as per AS 7 is concerned, or as per India 715 is concerned. That is called unbilled. So if any unbilled dues then that is to be shown separately. Amount due under contractual obligations are separate than these goods or services. Please ensure reconciliation has to be there. You have to at the end reconcile with the totals in financial statements. So undue. So first is what is we talk about is what the due. This is trade receivable aging for due but not received. One. Second is unbilled, or we can say undue. And third is unbilled. So due but not received plus invoice issued but not due. Third, invoice not issued, that is unbilled. So these three in total should reconcile with the total in financial statements. Coming to trade payable aging. Whatever we discussed for trade receivable aging, the same will also be applicable for trade payable and also be applicable to CWIP and intangible assets under development. Trade payable aging, in my views, again a very important point. Why? Because we have never given aging for trade payable. The amount has been there in a one line item. No aging has been provided so far for trade payable. Now this time you have to provide aging for a trade payable also, which a classification of less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So that is where which has been provided. Now very important part is that this is the aging part, and on this side this amount is to be classified into 4 parts. That is on MSME, others, disputed dues MSME, and disputed dues others. So this is to be provided basically, but however, please ensure that when you provide MSME here, the MSME means that you have to reconcile the MSME with the MSME form 1, which you may file to whom it is payable. Third, you also have to see that implications of interest on MSME, because as per MSME Act, any payment which is being paid beyond 45 days, it will attract compulsory interest, and if there is outstanding for beyond this particular period, then interest need to be accrued. So classification on aging point, this is critical. And on another part, you also have to look at this particular classification of MSME, others, disputed dues MSME, and disputed others. Then comes no due date payment. I think the same point which we discussed for trade receivable, same points are also applicable for trade payables. That if the no due payment is specified, then look at the invoice date, your transaction date, your invoice date. That will be focusing, that will be taking care of these things. Unbilled dues which are separately reconciled totally financial statements, disputed which we discussed. Now coming to next point, that is on disclosure regarding revaluation. Here, I think the applicability is not so vast compared to what we discussed earlier. Why? Because this particular point is applicable only in case where some revaluation is done. As you are aware that under AS 10 and Index 16 plus Index 38 intangible assets and AS 26 intangible assets, revaluation is not an optional choice. It's a revaluation model which have been following for regularly. So I have seen very few cases the companies follow for revaluation. So wherever the company has done revaluation, the Schedule 3 says that you have to show separately if the amount of change is at 10% or more in aggregate of the net carrying value of each property. And also it talks about the case where if the company has revalued PPE, the company shall disclose as to whether the revaluation is based on valuation by a registered valuer. So I think that is what is these 2 points need to be understood. First point is that If the reversion is done, then and if the change is 10% or more, then you have to show separately. And next point is that if the reversion is done, then you have to provide the statement that whether the reversion was done by the registered valuer or not. That information is to be provided under notes on accounts. What I've done, I also try to cover the relevant paragraph of CARO also along with Schedule 3, so that it will be easier for all of us to understand how the impact is on Schedule and CARO. So in CARO also the same thing has been there, where the audit is required to provide the amount of change if change is 10% or more, and also if the revalue is there, then the whether revaluation is based on valuation by registered value or not, that has to be provided here. So that change is there under CARO as far as these two clauses concerned. Now coming to the next part, that is on CWIP and intangible under development aging. The same aging which we discussed for the purpose of trade receivable, trade payable, the same aging also need to be provided for CWIP and intangible under development. It says that for following these you have to provide aging of what? Less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. However, you ensure that just look at this requirement. It says that you have to provide a classification into two parts. One is project in progress, and second is a project temporarily suspended. See, CVP is again a figure where it's a huge amount for a lot of manufacturing companies, and the amount has been is been piling up for years and years together. However, in certain cases, what happens that for they have been spending for a certain project has failed, but it is not impaired because the management has always hoped that I will be able to use it. Because when you say impairment, it gives a negative impression on financial statements. So the figure in CWIP continues and it piled up for many years together, and there's no information provided. We just look at the old Schedule 3. The only information provided CWIP is opening, change during the year, and closing. No information as far as the aging or what is the quality of the CWIP. It is not in no way provided. Now it says that you have to provide a CWIP in two classified into two parts. One, project in progress, and second, project temporarily suspended. So this will again provide information to that if a huge amount is outstanding in CWIP, and that is pertaining to project temporarily suspended, means this amount is at risk. It provides the information to stakeholder that this amount is at risk. As we discussed, the total of this amount shall tally with CWIP amount in the balance sheet. Now, question which is whether I have to provide disclosure project wise or I have to provide disclosure in totality. See, the disclosure has to be provided here in a totality. There is no requirement to mention project wise informations here. All projects together to be classified in two parts. One is the projects in progress, and second is the projects temporarily suspended. The question which is there is various items in single project with different dates. Now what happens that there is one project in Ankleshwar, અને અંકલેશ્વર જે પ્રોજેક્ટ છે એમાં કન્સ્ટ્રક્શન થયું બિલ્ડિંગનું, પ્લાન્ટ માટે રીડેવલપમેન્ટ લેન્ડનું થયું. Then there is furniture, pictures, office equipment which has been purchased, machinery is purchased. So there are various transactions, various invoices with the different dates. So question is that in that case, for the purpose of computing the aging, shall I consider aging from the project as a total one, or shall I to consider aging from the transaction date of every transaction that is part of project? It has been clarified by the IC guidance note that in that case we need to really do it from the date of different dates. So every date of invoice for different transactions should be the date for me for computing aging. Temporary suspension. Now it's possible that the project may be temporarily suspended, and that is to be shown separately. What do you mean by temporarily suspended? And that is where there can be issues, there can be a debate. But as an auditor and as a management, we need to look at the suspension reasoning. If any hold in the process, hold in project is required as a part of my project requirement, then it's not a suspension. Then it is something which is mean must and necessarily from project point of view. So project temporarily suspended means a project has been really suspended temporarily and it may be about to rebound very future. In this status, what about previous period? Earlier the amount was in project temporarily suspended. Now it is part of project progress. So how can I modify? Can I modify previous years? The answer is no. Your disclosure is as of the reporting date. So if a project was temporarily suspended last year and now the project has been progressed, so last year's should be in temporarily suspended and current year's balance should be in project progress. So next part, that is next point, that is on CV B, is that the CV completion is overdue or has exceeded its cost compared to original plan. So I think now next part is that where we want to focus more on, is there any overdue or if the cost has been exceeded. So there are 2 points where we need to see. First is that the cost overruns, where I already incurred cost which is higher than the cost which is original plan. Second is that overdue time limits. Earlier the project was for 3 years, now it is a more than 3 years, it may extend 4 years, 5 years. So both these information are very important for stakeholders to be understood. So here you have to provide information project wise. So project wise information is to be provided. And then again aging. Here aging is what? To be completed. So within how much period you expect to be completed? You complete in 1 year, 1 to 2 years, 2 to 3, more than 3 years. That information is provided here. Then comes original plan. What is original plan? Original plan is something which has been the first point. See, we also have to look at the documentation management. We also have to look at the documentation when the plan was approved. So original plan is always the plan which has been approved. If there is extension of the original plan, which may not be so much material, in that case, that extension will be counted as only original plan. This information is provided at project level. You can also aggregate immaterial projects. Now coming to the next part, is on financial issues. Along with the information of aging which we discussed, one of the most important part is on ratio analysis. All the ratios which are generally being used by auditor or by bankers to evaluate the financial position of the company. Now, this information is to be provided as a part of financial statements. So, auditor has to or management has to do by themselves all the changes which is done, and then ratios to be provided. As I discussed that every figure in financial statement should have a comparative figure. So the comparative figure should also be there for residential for the ratio analysis. Now let us look at 11 ratios which are required to be provided. First is current ratios, then debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, NP ratio, net profit ratios, net capital turnover ratios, return on capital employed, return on investment. So these are the 11 ratios which is provided. Again, this is not only about ratios, but you also have to explain the items that are included as a part of numerator and denominator. So just forwarding ratio will not absolve you from responsibility. You also have to provide what is numerator, what are which are elements of numerator and denominator, which are the elements of denominator. That also has to be provided. Next come is about, can you change your ratio for current year is 1.1 is to 1. Can you improve to 1.33 to 1? Can you change? Yes, answer is yes. But however, you cannot change the basis. The numerator denominator is a base. So once you have a formula of numerator where you're taking certain item as your numerator as a denominator, then that item should not be ideally changed because the numerator denominator conceptually should remain same irrespective of the period. Now comes the very important part, that is to explain the change in ratio by more than 25% as compared to the preceding year. Here it says that you have to compare current year with previous year, and if the change, which is plus or minus, is more than 25%, then you have to explain the reason. See, again, I'm putting the very important point to all of you that uh, whatever is disclosed in notes and accounts of financial statements, that is a responsibility of management. You may or may not be disclosed. If they don't disclose, fine. It is a non-compliance from their point of view. If an auditor is there and something is not disclosed, it is material in nature, auditor may have to disqualify it. So any change in ratio by more than 25%, it has to be explained with the reason. With the illustrative format of this ratio analysis. Now coming to the next part is CARO. In CARO, there is an increased responsibility on the shoulder of auditor. It says that on the basis of financial ratios, aging, and expired date of realization of financial assets and financial liabilities, other information, upcoming financial information, whether the auditor is of the opinion that no material necessity exists as on the date where the company is capable of its meeting of liability existing at the date of balance sheet as and when they fall due. So here the response is on CARO, where the audit is required to look at not only financial ratios but also aging financial ratios, then pattern of realization of financial asset, financial liability, other information or is knowledge. One is to conclude that whether this is a fit case for the purpose of this, whether the company is capable of meeting its liability or not. That has to be confirmed by the auditor in CARO. Coming to the next part, that is on closed group related. Disclosure of promoter shareholding and loans and advances granted to promoters, disclosure KMP and the related party. Promoter shareholding. I think the most important thing here is that this is compulsory to be provided. Promoter means promoter is defined in Committee 2013, and details shall be given separately for each class of shares. Percentage change shall be computed with respect to the number at the beginning of the year if issued in the year for the first time, then with respect to date of issue. See, we all are aware that at this juncture, if it is more than 5% shareholding, which is to be provided and disclosed in notes and accounts. If the promoter has less than 5%, like 3%, there is no need to provide disclosure of promoter name, what is percentage which is owned by promoters. However, as per this disclosure concern, every promoter, irrespective of the percentage, their name, their number of shares, and percentage change has to be provided in notes and accounts. Now, one can escape from this responsibility. Coming to loans and advances to related parties. If the loans are granted to promoters, directors, KMP, and the related parties, either severally or jointly with any other party, they are repayment demand. And without specific terms of period of repayment. So basically, if any loan has been given to promoter, director, KMP, and related party without specifying terms or period of repayment, and which is repayable on demand. So if any of the cases you have to provide the disclosure that what is the type of promoter, is a promoter, is a director, is it KMP, is it related party, what is the amount of loan outstanding, and what is percentage to total loans outstanding. So this is still provided, and relationship should be considered not as a date of loan. It is on the date of loan. So at the time when the loan has been given, at the time, if he is a promoter or director or KMP, that information you have to see, and the outstanding amount is provided as on the balance sheet date. There is a responsibility on auditor that in CARO 2020, you also have to provide that whether the company has granted loan in compliance with the section of Companies Act 113 or not. So responsibility is there also in CARO for this clause. Go to the next part, that is on control of property. So there are 3 points which have been changed. One is details of benefit property held. Then relationship with the stock of companies, and then detailed disclosure regarding title deeds of immovable property not held in the name of company. Let us look at the first point, which is a very important, but however not very so much applicable, which is on details of benefit property held. See, this provision says that if any proceeding has been initiated or pending against the company for holding any benefit property. So this part will come in picture only when any proceeding has been initiated or pending against the company for holding any benefit property. What is benefit property? Which has been discussed in the Benefit Promotion Transaction Act. The only thing which you have to verify is that whether any proceeding has been initiated. If answer is yes, the disclosure is required. Second thing, if it has been already initiated earlier, but it is pending, then again you have to provide disclosure of the fact and what is the status of this particular benefit property. Same requirement on CARO, where auditor is required to check and confirm. Come the stock of companies. Now this is a very important point where unnecessarily a lot of hurdle has been there, because here the clause says that if any amount is receivable, payable, or if any transaction is done with stock of company, then that is to be disclosed separately in your financial statements. The objective of doing this disclosure is such that there are around more 3 lakhs companies are struck off by ROC, and there are also equivalent number of companies having struck off voluntarily by the companies. So in the struck off, sometimes the amount for which the receivable is there, payable is there, because for struck off, if it is done voluntarily, it is compulsory that the balance sheet should be nil. However, when it is not voluntarily struck off, then the amount can be shown receivable in my books of accounts, and that receivable amount is shown struck off company. So when the company is already struck off, the amount to be receivable from the company has a very less chance. Same way amount payable, you have to pay the amount to XYZ company, and the company is struck off. So we have to be worried, and then we have to ensure that my financial statements provide true and fair view. So I have to change my receivable payable in such a fashion so that the amount which is there in financial statement is correctly done. So here it says that you have to provide disclosure of outstanding balance with the stock of companies into this classification. First, investment securities, receivables, payables, shares held by stock of companies, and other outstanding balances. But practically, when you look at the practically, it is not so easy, because the MCA uploads on MCA website the list of stock of company, and this list is been uploaded by every MCA separately. So there is no consolidated list is available. Every MCA, basically every MCA ROC, every ROC in the state will upload their list, and that list is also in PDF file. So now if you have to do cross check with your supplier, customer, and other balances, there's no option for you to cross check with Excel file. Because these all are under PDF, scanned PDF, and these are separate for each state. Every ROC under particular state has separately uploaded files. So on our side, we need to really ensure its compliance is. Next is title deeds of immovable property not held in the name of company. The company shall provide details of all immovable property other than the properties where the company is a lessee and the lease agreement are duly executed in favor of lessee, whose title deeds are not held in the name of the company in format given below, and where such immovable property is jointly held with others, details are required to be given to the extent of company shares. So the objective is to again identify the title deeds if they are not in the name of the company. There has to be a very, very critical part where the management, where we have to really see that all property which are there in the my balance sheet, they should be part of my balance sheet only when the title deeds are held in the name of the company. This can be a format in which this information will be provided. First is that a PP investment property, PP retired from active use, held for disposal, others. Then you have to provide description of property. This is for immovable property. So immovable property can be either land or building. It is not talking about anything, any other things. If, for example, car, generally we have seen that in case of car, the cars are in the name of the individual person, it can partner or director of the company. How the car money is being provided by the company from its bank account. In this particular clause, this will not be captured because this is primarily talking about a case where the land or building is there and this land or building has been in the name of the company, which is and whatever line item in the name of the company that has to be provided here. And here you have to provide a gross carrying value. Title deeds are held in the name of whom, whether it is held, whether it's promoter, director, relative, since how much period, since when this property is held as such. This is since 1996, since 1978. So that year has to be provided. And what is the reason for not being held in the name of the company? So these three, four things are critical as far as this is concerned. And there is increased responsibility on the auditor to comment in CARO about the title deeds of all immovable properties. Disclosed in financial statements are held in the name of the company, if not the board details thereof. Now the next part is on control on fund movements. Disclosure on secure movement of funds is very important part, which is covered here. Then use of borrowing for a specific purpose. Disclosure when borrowing is based on security of current assets. Disclosure in case a company is a declared willful defaulter. Complies with number of layer of companies. Let us first look at disclosure on secure movement of fund. Now this is a very important and critical and difficult to actually, if you just look at, it's a very big large statement which provides. First it talks about in which case you have to disclose. Second case it talks about that what is to disclose. This is a very it's important. Why? Because this has been started with the objective that we all are aware that in case of Mehul and Choksi, Mehul Choksi and Nirav case, what was the case where there has been a lot of fund seclusion is there. Fund was given to A by A to B, B to C, C to D, D to E, E to F, and at the end of the whole transfer of movement and trail, the fund used to be siphoned off out of India at certain places. So this trail was seen by the government at various fraud and scam. So they were just wanted to put additional pressure, additional responsibility on the auditor that you also have to look at this fund, and then you have to identify whether this fund has been transferred to other person, not for the benefit of other persons, If the answer is yes, then you are to disclose separately. Let us look at requirement. Says that where the company has advance or loan or investor fund. See, the most point is that the word was borrowing fund. How it also includes the own fund, borrow fund, or share premium, or any other source kind of fund. So if any fund has been advanced, loaned, or invested, so there is a transfer of fund is happening. That says that with the understanding that the intermediary shall directly or indirectly lend or invest in other person or entities identified in a manner or provide any guarantee security on behalf of the ultimate beneficiary. If answer is such, then you have to disclose the following. See, Miss, for example, if I have given a loan to Darshit, with the understanding that this loan is not for Darshit, but Darshit has to transfer loan to Romit, with the understanding that this loan is not for Romit also, but however, Romil has to transfer this fund to Chintan Thakkar and then from Chintan Thakkar to somebody else. So the transfer of fund from A to B to B to C to C to D, D to E, they all have been done with the understanding and objective that the fund to whom it has been given is not for him, but however for somebody else. That is called trail of fund movement. And if that is such trail is that it is a responsibility on management to disclose that thing, and also on the responsibility on the auditor to check and confirm. First, we discuss about the fund which is given. Now we're talking about fund which is received. Both the parties, the party A, which is giving fund to somebody else for which the fund is not there, then party A has to disclose, and party B, who is receiving the fund, who is receiving a fund not for himself but for somebody else. So the party B also has to disclose these things. So every party is connected in the chain where they have been transferred not for the purpose for which it is there. Then this has to be disclosed separately in financial statements. Now there are few transaction, few terms which have used: intermediary, funding party. They all are as per the guidance which is provided by ICI. Advancing in the ordinary course of business. See, here the point is that if the advance has been given, which is in the ordinary course of business, then it should not follow. It should not basically follow, or there is no need to worry about that thing because that is not included in this particular clause. Previous year transactions. Here the guidance note says that for this kind of clause, previous year transaction may not be required. You can just look at the current year transactions. It says a complete details to be provided. Complete details means what? It means the name of ultimate beneficiary. If that particular ultimate beneficiary is a company, the CIN number. So all information, whatever is available for this particular point, has to be provided. Then comes the with understanding. Understanding is again a word which is a required professional judgment, because it can be understood by way of the type of transactions. When you study the trail of transaction, you will realize that the person who is receiving is not receiving for itself, it is being transferred to somebody else. So with understanding, again the word says whether recorded in writing or otherwise. Even though it is not recorded in writing, which is generally the case, then also when you study the pattern of the money which is transferred, you realize that this money are not for the purpose of the person, but however for third party. Now the auditor's report, the main auditor's report, in terms of other changes we discussed about, that there's a change in schedule 3. However, here the change is main audit report. The main audit report has been modified to include this point of point. Now coming to the next part, that is on the borrowing, where the company has not used the borrowing from banks for a specific purpose for which it was taken at the balance sheet date. See, if the bank has given you a borrowing and the purpose has been identified, it's called specific purpose. So it is you are duty bound to ensure that the fund has been used for a specific purpose for which the loan has been given. However, where the company has not used the borrowing from bank and financial institutions for a specific purpose for which the loan has been taken, then this has to be disclosed in notes and accounts. Comes the where the company has borrowings from banks or financial institutions on the basis of secured fund assets. This is a very important point. Please take into mind because in majority of the companies will identify that wherever the company has taken a CC limit, then in that case, this particular point will be a very important point. What says that if wherever the company has taken borrowing from bank or financial institutions on the basis of security of current assets, I think most important things are two. One should be just talking about from bank or financial institutions. Second thing is that it is also talking about the first is the comfort level of the employees who are sitting there. If that is situation, then it is disclosed that whether quarterly returns or a statement of current assets filed by the company with bank or financial institutions are in agreement with the books of accounts. So point here is that the statement, if it is be submitted by the company to the bank as the company has been taking over CC limit, and then as a part of CC limit, the security may be provided as a current asset. That is loans drawing power is being calculated based on the security of current assets. So it is very important for the company that whatever statement is provided to the bank, that statement should match with the books of account. I think the most important thing is that when they look at the insolvency bankruptcy code, during IBC they realize that whatever amount is shown in the books of account and the actual amount is completely different. So then there is a huge loss to the to the company. So now what has been decided here is that the returns or statements shall be provided because the drawing power is decided based on the stock and debtors aging. So whatever returns or statement provided by the company to the bank, that should be in agreement. If the company is if the company is submitting monthly returns like every month, January, February, March, then what? Then it says that you have to follow these requirements, and then June month is treated as a June quarter. So April, May, June is July, August, September, then June month, September month, December month, March month. They all had to follow same. And if the statement has been provided, which includes the figures and the state and the and books of account, those are not in agreement, then you have to provide a reconciliation reason why the books of account is different than the statement is provided. If the borrowing is not based on the basis of current assets, then this is not applicable. This is applicable only when the borrowing has been taken, which is a working capital borrowing, which is on the security of current assets. Only when this is taken on security of current asset, then only you will deal, otherwise not. As I discussed that if the company is submitting a monthly returns, and this clause talks about the quarterly returns, then what? So you have to consider June month, September month, December month, and March month. So these 4 months you have to consider separately. Now, now when you look at the CARO requirement, the same provision is there. However, the only restriction here is that it says more than 5 crore. So if you don't have CARO, then you have to be applicable everything in financial statements. If the CARO is applicable, then in CARO reporting, if the turnover of the company is less than 10 crore rupees, then this is to be seen. And then you have to check, reconcile, and if the difference, if any, you have to report in your CARO reporting. Come next part is a willful defaulter. If the company has been declared as a willful defaulter by a bank or financial institutions, then the following details should be provided: date of declarations as willful defaulter, details of default, and then willful defaulter is a person or an issuer which is categorized as willful defaulter by any bank or financial institutions or consortium thereof. So where some company has been basically categorized as a willful defaulter, then covered. If it is individual, if it is not a company, if the director of the company is being categorized as willful defaulter, then there is no need to disclose in my view, because this particular requirement is only for a company, not for director. If the company has been declared as willful defaulter voluntarily, the answer is yes, you disclose here. Now comes number of layers. Under section 186 of Company 2013, it says that investment shall not be done beyond more than 2 layers. And again, RBI has made it very strict provision that you cannot make investment for more than 20, more than 2 layers. So, however, if there are certain layers which is more than 2 layers, then you have to provide a disclosure for that particular companies which is beyond 2 layers, which says name of the company, CIN number, and the relationship or external holding that is provided. Come next part, that is on presentation, complies with laws and disclosure thereof. That includes 5 parts. One is complies with approved scheme of arrangement. Second is pending registration of charges or solicitation charge. Third is disclosure of CSR. Fourth is disclosure of cryptocurrency or virtual currency. And then lastly is details of undisclosed income. Let us look at first part, that is complies with approved scheme of arrangements. There is scheme of arrangements has been approved by competent authority. In terms, then the company shall disclose the effect of such scheme arrangement, that whether they have been accounted in accordance with the yes or not. So in general, if there are amalgamation is done and the amalgamation is done, then company has to check accounting treatment of amalgamation. Then it has to be determined that whether the accounting which is done is in compliance with AS or not. So that is only in case of approved scheme of arrangement. Registration of charges or certification with register of companies. Where any charges or certification is yet to register. See, for charge registration, generally the banks follow you, and if the banks follow you, you will get registered, because the charge registration is something which is critical for bank, and they will follow up and you will get registered. However, in many cases, it is observed that even satisfaction of charge has not been seen. Charge is taken, loan is taken, and then after 3 years, the loan has been repaid. There is no charges left. Still, it is still being shown and disclosed as a charge yet to be registered, yet to be satisfied. So I think this is a very crucial change as far as charge registration is concerned. CSR has been one of the most important points for the government. A government wanted to ensure that the CSR spending has been done for a right purpose, because CSR has been started, but the actual implementation is not been seen. We cannot see its impact on the financial statements of a small medium company or group. So, however, it says that in case of the companies which are covered to comply with section 135, then the following shall be disclosed. One, amount required to be spent by the company. Second, amount of expenditure incurred. Third is a shortfall at the end of the year. Fourth, total previous year shortfall. Six, reason for shortfall. And seven, disclose details of verified transactions, for example, contribution trust, control company in ratio CSR. These all have to be provided. Now comes a part that is on basically CARO, but it says that in case of ongoing projects, in case of ongoing project, if the amount has been not spent during the year, then the company is required to transfer amount to a special account as if for ongoing budget. For other than ongoing budget, if the amount is not spent, then unspent amount is required to be transferred to fund that is specified in the Schedule 7 or to the Companies Act 2013 within 6 months. So that is what is very important. Now coming to next point is a cryptocurrency or virtual currency. Cryptocurrency we have seen it is now everywhere. Income Tax Act has talked about cryptocurrency. Also now Schedule 3 says that if the company has been dealing with cryptocurrency, it should provide disclosures that whether the company has traded or invested or not, and that disclose is profit or loss on transactions, amount of currency held as a depositing date, and if the deposits or advances from any person for this purpose, then that has to be disclosed separately. Undisclosed income, the company shall give you details of any transactions not recorded. See, the undisclosed income, surrender of undisclosed income generally takes care when the such survey is done. And in case of such a survey, if the company has disclosed or surrender any undisclosed income, so that should be part of my financial statements. It says that wherever there is a surrender of undisclosed income, it has to be first voluntary. Second very important thing is that accounting of these need to be checked. Accounting of these need to be verified with respect to the various account standard which talks about prior period item or not, and from which period it particular item becomes part of the acquirer. Now next part is on presentation related changes. Here the changes are rounding off. First, very important change, as I discussed earlier, that rounding off is something which is very important, applicability in all cases. Second is presentation of PPE and intangible assets. Third is a classification of current maturity of long-term borrowing. Fourth is classification of security deposits. And fifth is a presentation of grants or donations received. So let us look at the first very important point, that is on rounding off. Rounding off is compulsory. I have mentioned it a couple of times, and now again I'm mentioning why, because we don't have a habit of doing rounding off for a small companies. However, now rounding off is compulsory even though your turnover is just 1 lakh rupees. So if your total income, now what here is that total income is what? Turnover plus other income. The total income is less than 100 crore rupees. The rounding off is to the nearest hundreds, thousands, lakhs, or millions, or decimals thereof. If the total income is between 100 crore or more, then rounding off should be lakhs, millions, or crores, or decimals thereof. So basically, when you look at here, it says that based on the size of a company, you have to do rounding off. For a smaller company which is less than 100 crore total income, then your option also for 100,000. For larger company, the option is only lakhs, millions, or crores. On the face of balance sheet, please see that the face of balance sheet, it has been now changed to basically the PP and intangible assets. On the face of balance sheet, basically there are point. It says that property plant company is a group head. Under that property plant company group head, earlier is a PP plus intangible assets. So that was a mistake. Actually, it should be PPE and intangible assets. So that is now been modified, and on the face of balance sheet, it has been made clear that heading should be PPE and intangible assets instead of only PPE. Coming to the next part, which is a very important point, which is on basically current maturity of long-term borrowing. I think we all are aware that if there's a term loan which is of more than 1 year, then any amount which is payable within next 12 months from the reporting date, that amount is called current maturity. And current maturity of long-term borrowing is to be shown as a part of other current liability as far as the old Schedule 3 is concerned. Now, in revised Schedule 3, or I can say the amended Schedule 3, it has been made clear that the current matured long-term borrowing should be shown as a part of your short-term borrowing and not as a part of your other current liability. So I think this is a very important part. Why? Because what happens that it has been shown as other current liability for so many years. Now it is being said that it is shown as a part of a short-term borrowing because your debt equity ratio will also be changed. In general case, if you take as part of other current liabilities, then what will happen that your debt equity ratio will be different. However, the nature of this borrowing is of borrowing, not a current liability. That's why it has been regrouped and reclassified as a short-term borrowing, not other current liabilities. Security deposit should be shown as a part of other non-current assets. Earlier, it was shown by the loan advances. If it is long-term loans advances, now it is other non-current assets. If it is a loan advances, it is short-term. Now it should be shown as part of current assets. So security deposits should be disclosed as part of current, non-current assets, other non-current assets, and not as a part of loans and advances. Now comes profit and loss statement. On profit and loss statement, there is a very few small changes, which is talking about total income. Earlier it was said revenue plus other income is called total revenue. Now it has been modified to total income, which is correct. It is just mistake earlier. So revenue plus other income becomes total income. That is now being changed. For Section 8 companies, revenue from operations shall also include further classifications, grant or donations received. Now I'm talking about other amendments. So for India's companies, the amendment which we discussed earlier, these are already there. And then there are additional amendments under India's. So for India's companies, amendments which are applicable to AS companies are also applicable. And then there are additional amendments which are, I'm going to give you a brief synopsis of additional amendments. First is the changes in equity share capital due to prior period. So now there is a requirement to show separately this part, even though it is not required to be shown separately. However, this has to be shown separately as far as India is concerned. Fair value of investment property, as we discussed, the same for PP intangible assets. So whether the fair valuation is done by registered value or not, same way where there is a disclosure of fair value of investment property, you have to mention that whether this fair value is arrived based on the valuation of registered value or not, that is to be disclosed. Finance lease obligations, the finance lease obligations shall be shown after borrowing. So it is a part of current non-current liabilities. However, earlier it was be shown as a part of borrowing. Now this finance lease obligation should be shown as a after borrowings. We have already seen the aging schedule of trade receivables. Now, the aging schedule of trade receivables will have additional classifications into disputed or undisputed trade receivables, which has significant increase in credit risk. So when you look at the trade receivable aging schedule, that trade receivable aging schedule again is to be subclassified to various part, and that also includes a one part that is a significant increase in credit risk under Ind AS 109 financial instruments. There's a need to also provide disclosures of a significant increase in credit risk separately. Now let us look at the additional CARO amendments. I'm again making a very, very important point to all of you that the Schedule 3 and CARO, they both have been revised. They both changes are applicable for financial year 2021-22. So for the year, this year, when the accounts have been reviewed and the CARO, if applicable, there's no change in CARO applicability. The CARO is applicable to same companies to which it is applicable earlier. However, number of clauses have been increased drastically. Now there are 21 clauses and there are more sub clauses. So there are around 25 plus changes are done. More than 25 clauses and sub clauses have been amended, have been added as a part of responsibility of the auditor. Let us look at now the few changes which are not discussed and by Schedule 3. So first is internal audit system and internal audit report consideration by a statutory auditor. So then cash losses in financial year, resignation of a statutory auditor and consideration thereof by income auditor, consolidated financial statements. For the first time, the CFAs will find some small portion of CARO, inventory, physical verification, and redeemed deposits. First point, internal audit system report. So it says that there are 2 points which are added here. First, it says whether the company has an internal audit system commensurate with the size and nature of its business. So now, if you just remember, there were earlier in old CARO, there was need to discuss and provide some information about internal system. Now it says that we need to comment on the commensurateness of the internal system within size and nature of business. But second point is very important point, which is added here. It says that whether the reports of internal auditors for the period under audit were considered by the statutory auditor. So here it says that it's compulsory now for the statutory auditor to consider the report of internal auditor. It cannot say that the internal auditor report is not been seen by me. If you have not seen, you mention that I am not considered it. So now it means that the government, regulatory authorities, and the stakeholders expect that the statutory auditor should consider report of internal auditor even when they plan for internal audit. So internal audit system is what? It's again a combination of various important processes, system, policies, which is there with the company. And the role of statutory auditor is very high, that they need to really understand that there may be a requirement to change and upgrade the audit process based on consideration of the points of internal auditors. Next point is on cash losses. That the company has incurred cash losses in financial year in the immediately preceding financial year. So cash loss by word, it means that profit after tax plus all non-cash items to be added here to arrive at the cash loss. So one has to arrive at this particular figure and then see that whether the company has been incurring cash losses in current year and immediately preceding year. So for both years, the auditor has to check and report and comment. Next point is on resignation of a statutory auditor. The government looks at resignation as a negatively. If any auditor resigns, means there is a possibility that there may be some negativity in the company's the books of accounts. So here the amended CARO requirement says that in case of any resignation of such an auditor, and if you're incoming auditor for the first year, you have to comment, said whether you have considered the all issues, objections or concerns which are raised by outgoing auditor, and they have been appropriately dealt with or not. So that is specific requirements, the responsibility on the statutory auditor, on the incoming auditor, to consider all objections and concerns of the outgoing auditors. Next point is on material certainties of meeting its liabilities. So now the auditor also is not only basically a person who understands financial accounting, but he is also an astrologer. Why is astrologer? That here it says that whether the company is capable of its meeting its liability existing at the date of balance sheet, as and when they fall due within a period of 1 year from the balance sheet date. So here the responsibility that it is a position of astrologer, where the regulator expect that the auditor has to estimate that whether the company is a capable, a company will be capable to meet the liability of next 1 year not. And for that we need to refer to many informations. It's not only one thing, which includes the financial issues, aging, expiry date of realization of financial asset liability, other informations, or is knowledge of board directors, management plans. So after considering everything, we need to conclude that whether we feel that the company is capable of meeting its current liability. Just to make it very simple, current liability. So liability which is going to be fall due within the next 12 months, whether the company is capable to do that or not. CSR, I think with this point we discussed earlier that for a CSR, if the fund has not been spent, then the fund need to be transferred to a separate account for ongoing projects. And if there is no ongoing project, then it is to be transferred to a separate fund. So that is done or not, that is to be basically reported, checked and reported by the auditor. Coming to the next point, there's consolidated, as I mentioned, that for the first time, even in a consolidated audit report, you will find CARO reporting. What is CARO reporting? There is no need to do a CARO for a consolidated financial statement. However, in case of the consolidated auditor, they need to do compilation of all observations, comments, negative observation, comments, remarks of every auditor of components. So component auditors, if they are given observations, comments, qualifications, adverse remarks, the compilation thereof that has to be provided by the consolidated auditor in that audit report. There's no need to provide the whole comments. The only thing is that you just give reference to that particular paragraph, reference to the paragraph number in the CARO report. Inventory physical verification. See, the physical verification inventory has been the point since so many years. Now the twisting is what? It has been said that in the opinion of the auditor, now let's just look at in the opinion of the auditor, coverage and procedure of such verification by management is appropriate. So earlier we are required to discuss on reserve interval, whether the physical verification of inventory is done by reserve interval or not. That is what is other requirement. Now our responsibility has been increased a step further. It says that the coverage of verification, just look at coverage, whether the management has done adequate coverage. So for that particular point, I have to get the information from management, how many stock you covered, what was the size of stock you covered, and then also I have to look at procedure of verification. What are the procedure management is done? I have to understand procedure, whether the procedure is appropriate or not. So that particular requirement gives additional responsibility, and that means that the auditor also has to get the documentation of the inventory which is done by management, and also need to look at the details whether the coverage and the procedures of verification which is done is appropriate or not. Deemed deposit, I think smartly, just one a small word, few small words have been added in the existing compliance requirement. Smartly, I will say why, because there are just added the deemed deposit or deemed deposit and matter over. So see, I think we all are aware that there may be a lot of issues in various small companies regarding a deposit. And for the purpose of compliances of deposit, the most important thing is seen is that is it excluded. So what is being said is it excluded. It is excluded when, for example, if you're receiving any advance for goods or services, and the 365 days are not over. So till the time 365 days are not over, it is excluded from deposits. Once 365 days are over, it is called deemed deposit if the amount is not returned within 15 days. So earlier the requirement was only on deposit. So we are not required to check about a deemed deposit. Now it says that your responsibility has been increased now a step further, and says that if any deemed deposit, then whether the compliance of section 73 to 76 is done or not done. Because if it is deemed deposit, in that case also the company is required to return the money. If it's not returned, then company has to comply with section 73 to 76, which require the complete requirement of the deposit sections. So this has been addition of word in the deep deposit. I've just listed down certain the points where the deemed deposit, but however, I know that it's 6:50, and I would like to cover the few questionnaires from you. So this is just a summary from the deposit rules, and whenever the deposits, wherever the amount, whether the deemed deposit has been converted, whether there's expiry of the period, then you have to see that is it deemed deposit. If it is deemed deposit, then yes, we have to also check compliance of section 73 to 76. Now, this is the last slide before I end, and in this last slide, I have tried to have summary of the practical important points from small, medium-sized companies. Because in many cases, we may believe that this is not applicable in my case. For example, Benami properties not applicable, fund securities not applicable. Then, if you talk about willful defaulters, not applicable. So, if we just want to understand, concentrate on a small business companies, in my view, these are the few points which are applicable in majority of the companies. Wherever there is some business, if there's no business, I think then this can also become like zero, because these all are primarily based on business, even for a small company. For example, aging. We discussed that trade receivable aging is compulsory, where the instead of less than 6 months, more than 6 months, you have to provide more than 6 months into 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Trade payable aging. Again, you have to provide trade payable aging with less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Capital work in progress, intangible asset under development. So all these three cases, aging is frequently provided. But we do ensure that aging is not only to be provided, but we also have to do additional tasks of auditing and ensuring that the amount that reflects in aging is appropriate. Is there need to provide additional provision for doubtful debt? The amount is payable and shown in MSME, that should be reconciled with your MSME 1. So this is, in my view, applicable to my various companies. Second point is that borrowing based on security of current assets. Wherever there is working capital loan, generally they are taken based on security of current assets. So in that case, the statement that is being submitted, quarterly statement that is submitted to the bank, that has to be checked to see that are there any agreement or not. Ratio analysis, 11 ratios to be provided. So ratio analysis need to be again do, and this all things are for both years, current year and previous years. Rounding off must, compulsory, even if the company is a zero nil company, no business, no operations, but I am sure that this rounding off need to be done. So there has to be a process which is to be established in every CA firm to see that they are able to convert rounding off. Excel based or some software can be used for rounding off. Classification of current maturities. Classification of current maturities of long-term borrowing. So if there's a long-term borrowing is there, and in that case, the current maturity long-term borrowing should be shown as part of short-term borrowing and not as a part of other current liabilities. And lastly, we discuss about the additional CARO obligation. CARO has been increased manifold. The response has been increased manifold. So CARO is applicable to the companies to whom it is applicable. However, the Schedule 3 is applicable to every company, and practically we have to be aware about the Schedule 3. Even though the Schedule 3 is a responsible management, but however, from the auditor responsibility, we need to review that, or sometimes we are also helping the management. So we need to be aware about these changes and gear up ourselves. So I think these are the few points, and it's already 6:53. Last 5-7 minutes are there. In case if any questions, please feel free to ask me questions in chat box, or you can unmute and basically reply. रुबिल भाई, आई थिंक चैट बॉक्स में कोई क्वेश्चन है नहीं ने?
ना कोई आ दो ना.
Okay, so anybody any question? Because I think about important point is તમારા કોઈ questions you may faced somewhere, and if you want to really touch upon that, we can discuss. If it's not, I think maybe we can end, and I also have, you can also go through this particular YouTube video if it's uploaded by Gandhinagar CP Circle. Plus I have also framed a short course on this. In case if you wish to go through that, you can also go through that course also. With this, I hand over charge to Romil bhai.
Thank you, Chintan sir. Now, on behalf of Gandhinagar CP Circle, I thank you, Chintan bhai, for such a wonderful seminar and fruitful seminar on the topic of Schedule 3, Reverse Schedule 3 and the CARO. In future, any query regarding this, we definitely call you.
Sure.
And also thank you. Within a short time phone call, you have agreed for this seminar.
Always, anytime, Romil.
Okay, sir.
Okay, thank you. Bye.